Folks, large caps and small caps. Why do sometimes investors and large institutional traders go into large caps, and why do they go into small caps? That's the big question. Large caps are blue chips, larger, more bloated stocks. Intel, Caterpillar, Amazon, stocks that trades millions and millions of shares a day. And small caps are Russell 2000 stocks, stocks that have a market cap of less than $2 billion. So in today's video, I'm going to explain why speculative stocks tend to lead sometimes, and why blue chips tend to lead sometimes, and what does it mean, what's in it for you, and how you can benefit from all of this. Folks, I have big news, and the timing on this is critical. There's a massive shift happening in America's capital markets right now, and it's measured in the trillions. And I've identified the one stock that most stands to benefit. Click the button below now to find out what it is. I have 25 years of major experience here, so when I say this is big, it's big. I'll tell you more about it in a few minutes. First, let's dive into today's lesson. All right, so the question is blue chips, large caps, or speculative small caps? When does Wall Street invest in large caps? When do they invest in small caps? When should you invest in small caps? When should you invest in large caps? That is the question for today's video, and that's what I'm going to talk about today. Now, here's a primer. Here's what you need to know. And I've talked about this before in the intro, but I want to touch on it a little more. When we talk about large caps, we're talking about Dow 30, we're talking about the S&P 500, and we're talking about the NASDAQ 100. Those are large caps. There are other stocks, but if you want to be sure that you're talking about the right stock, check to make sure it's in the Dow 30, the S&P 500, or the NASDAQ 100. Now, if you want to make sure you have a small cap stock, check to see if it's in the Russell 2000. The Russell 2000 is an index that has 2,000 stocks, small cap stocks, that are ready to take off. Now, there's a lot of smaller stocks, like over-the-counter stocks. That's really not what we're talking about. We're talking about small caps, but stocks that still have a market cap of about $2 billion. So these are companies, think Netflix 10 years ago. Think Amazon 20 years ago. These are companies who have thousands of employees, who are already that is already public, that's ready to go from small time to prime time, but it's not there quite yet. Okay? So, large caps. When investors and hedge funds, and keep something in mind, 20, 30 years ago, retail investors had an edge in terms of having an impact on the market. These days, the stock market is run by institutional money. Pension funds, they roll money into the market every week. That's what drives the stock market, institutional money. Now, institutional money, when stocks are trading lower, when they're insecure, when there's a higher fear level in the market, institutional traders will always go to large caps, all right? And when markets are rising strongly and they believe that the market is extremely bullish, then they will buy small caps. So you will typically you'll see large caps rise before small caps, and you will see small caps sell before large caps. But that's not always the case. Sometimes, for example, interest rates. Let me back up for a second. Sometimes, and the reason why I'm saying this is these two indexes, the large caps, the S&P 500, the Dow 30, the QQQ, the NASDAQ 100, they don't have a huge correlation with the Russell 2000. Their correlation is small because there's not a lot of institutional sponsorship in these small cap stocks. Okay, so what you need to understand is this. At times, when there's a specific issue, like China, for example, it won't impact the small caps as much as large caps, because let's be honest with each other. What type of a stock has broader exposure with China? Amazon, or a small cap stock that's barely getting going internationally, to make sure you understand. So, small cap has a lot less global exposure. At least most small cap stocks have less global exposure than large cap stocks. So that's why when there's a specific situation that impacts cross currencies or has international ramifications, large caps could be hit ahead of small caps. So typically, as a rule of thumb, when stocks are rising, large caps will go first, small caps will go second. When markets are falling, small caps will take a dive first because they're smaller, they're more speculative, and investors and traders and hedge funds will liquidate them first. But when there's a special situation like a cross-currency situation or a tariff situation or something to do with global markets that impact the economy, when the economy is impacted, it'll impact large caps, and there's a good opportunity in small caps. So always try to figure out what's driving the market and why the market is being driven a certain way and what the catalyst is. If you can identify the catalyst, then you'll probably have a very good understanding and a very good way of identifying why large caps or small caps are leading ahead. And as a broad measurement, I'll leave you with this. You want to focus on the 50-day and the 200-day moving average, all right? Let me write this down for you here, because this is really important, and that's how you know if something is bullish or bearish. So, when you see the large caps above the 200-day moving average, okay? Moving average. Large caps, all right? When you see large caps above the 200-day moving average, you should begin looking at small caps for buys. And when the large caps are below the 200-day moving average, that's a good time to start thinking that small caps are going to be selling off further. They're going to have weaker relative strength. So again, look at the 200-day moving average as your gauge. Don't use the exponential moving average. Use the simple 200-day moving average. If large caps are trading above the 200-day moving average, look for upside on the small caps. If large caps are trading below the 200-day moving average, look for deceleration, look for selling pressure to begin on the small caps or increase. Hope that helps. Now, I want to tell you about that one stock that you need to own this year. I think this could be bigger than owning Amazon stock in 1997. Yes, seriously. This is a very big deal. Click the button below to learn what it is, what's happening, and how to use it to your full advantage. I'm not missing out on this one. Are you? Click the button below now. I'll see you there.